Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So Matt, on our P&L for Purpose live stream, you did an awesome interview with Corey Hoffstein, which was based on one of the best things I've seen written. Like, I always love these things where people like look at their whole career and say, like, here are my biggest lessons. I've done one, but it was clearly inferior to what's going on here. But Corey did a really good one where he said 15, he called it 15 ideas, frameworks, and lessons from 15 years. And he explained them. He managed in 30 minutes there to explain all of them. But I think both of us, when we watched it, said, like, you know, in terms of like taking people who are much less intelligent than Corey, like us, and like applying it to our real world situations, there was like a lot of lessons we learned as we were listening to it. And so I thought it'd be good to do a podcast. We probably won't get through all 15, but where we work through some of these ideas and how I think about it on the investing side and how you think about it on the planning side.
And I think the remarkable thing about both what Corey did with this list, so it's actually really hard to make a list of 15, let alone 16 things that are here about things that are actually different. Like how many books have you read, like business books, where it's like, here's 10 or 20 or 30 ideas about this thing, or 10 or 20 or 50 chapters about this thing. And you're basically like, 3 of these are unique, and the rest are some repeated iteration of the thing. Corey wrote 16 things that are actually uniformly different. And it's really remarkable as a testament to how deeply he's thought about this stuff. But I was blown away by how fast he went through it in the other episode. That's the P&L for a Purpose that you can get on YouTube here and just see that snippet. And just, again, a list of 15, 16 differentiated things that he did. That's really friggin' hard to do.
Yeah, it was really impressive how fast he did it. So now you're going to get our long-winded approach to add some more length to it.
Long-winded and full of BS. Let's do this, Jack.
I like it. I'm sure the listeners are looking forward to that. So yeah, number one is actually the thing I've most known Corey for. And some other people have done this and used it, like said it in a little bit different ways, but his idea is risk cannot be destroyed, only transformed. And I think about this a lot. Like ever since I heard that, I think about that in so many different ways. Like I always think about, you know, well, I'm getting rid of this risk from my portfolio, but I always think about, well, what's this other risk that's coming in? And I don't know if you have like a high level example. I have a few I could add too, but there's so many examples in investing and in planning of this idea.
I mean, the planning one, the layup planning example is like, this is why you have insurance. Like it's as simple as that. This is why we have everything from car insurance, that's basically money we set on fire and hope to never use, and life insurance, which also we, you know, hope to never use, but at least in like a whole life policy of some potentially residual cash value or whatever else, or you buy an annuity, or you put money into a pension or something. There's lots of versions of these things, and where we're transferring risk and we're getting help from somebody else to help hold this thing and offset it. And in the planning world, again, it's like you can transfer it. So I know that if I get in a car accident and I have to replace my car and I have, you know, thousands of dollars worth of damages, that blows a hole in my short-term, you know, my emergency fund or whatever else. And just paying that extra car insurance premium on whatever basis you have to pay it helps protect those other financial assets so I can get through a crappy period of life. It's such a basic idea, but remembering that the risk doesn't go away, I've just transferred how it's covered, is an infinitely useful financial planning concept. What about you on the portfolio side?
Yeah, well, I try to think about always like if I'm getting rid of a certain risk, what's the other risk I'm taking on? And I want to ask you if this is a good example or not. I was just thinking about this. This is more maybe a planning example, but I was thinking about it before. Like, let's say I have my retirement portfolio in the market or in like some sort of bond and stock allocation or whatever it is, and I'm growing it for the long term. You know, I'm trying to withdraw money over time. What if I take that entire portfolio and put it in T-bills, right? So have I destroyed any risk there? And the answer is, I think I've transformed risk there because I've taken the risk basically of the market and of the risky assets, and I've changed that into a risk that I'm not going to keep up with inflation, a risk that my portfolio is not going to meet my long-term goals. So like, I don't know if that's a good example, but I was thinking like, did I destroy risk in that example, or did I just turn one risk into another risk? I mean, do you think I have that right, or do you think that's a different way to look at this thing?
I think it's I think it's a different way to look at it. And I think some of the other ones get into the different aspects of this. Like we could probably, if we thought about this better, we could probably take just that point and literally apply it to everything you just said. The risk transfer piece inside of that is I transferred the risk of like portfolio. So if I knew piggy bank style, I needed X amount from my portfolio for consumption for the foreseeable future. And if the inflation risk was minimal or de minimis in my understanding, then technically like that idea is like the trade-offs here are maybe it was transformed. The reality of like shifting risk to, I don't know, the government and like tax receipts and the strength of the U.S. military and T-bills. Some commenter is going to pick up on that part of it. But the other piece is just like, I transfer the risk. So back to your point, like inflation and all the other things. Does it meet the goal for, as we talk about a million times over on this podcast, money's either going to be that we're saving, it's consumed or gifted at the end of the day. So if I took my risk profile, put it all in T-bills, took it all out of the market, like the reality is, am I going to consume through all of that? And was that a bad idea? Or am I trying to gift this all away? In which case, did I sell the beneficiary short? Or is this some weird, are you making some weird MMT statement or something with this?
So it's funny because I asked Corey this question around return stacking, because when I like didn't understand this concept perfectly, I thought about return stacking and I'm like, well, with return stacking, I'm adding leverage to my portfolio. Leverage has an inherent risk in it. So by adding leverage to my portfolio and then using these diversified asset classes, am I destroying risk? So does that violate this? And his answer was no, not really, because leverage doesn't always have risk associated with it. Like if you're using the leverage to add these diversified asset classes, it's not like you're adding risk and destroying the risk. The risk isn't there in the first place. So I think it's like, as I've understood this concept better, I thought that was like a really good example of how to apply this maybe at a deeper level.
This philosophical underpinning of like doing something means not doing other things is maybe one of the bigger philosophical through lines. And in Corey's work, and certainly in this list, you're going to make one choice, but that means there's a bunch of anti-choices that still exist in the world, and understanding those trade-offs. If nothing else philosophically, like your point about leverage, which is a mind bender, but mathematically you can put that in a spreadsheet and go like, crap, it's kind of right.
So to our point about us being long-winded relative to Corey, we have 7 minutes. We've gotten through 1 in 7 minutes. So clearly the 15 is not going to happen for us.
We're going to fly through this list. And this might be a two-parter.
Exactly.
We go halvesies.
The two of us, like with me rambling on about factors and your pop culture references, we had no shot to get through these things in 30 minutes.
We'll see what
it was never going to happen.
Well, take us to number 2. No pain, no premium. Explain this one.
This one is right in my sweet spot, which is basically, I kind of think about this like, if I start with, I have all my money in T-bills, and I want to get some sort of extra return, some sort of premium relative to that, pretty much everything I do from there on out is going to require some degree of pain. And so the T-bill example, I take my money from T-bills, I put it in the market. I'm now taking the pain of, I've got to endure whatever the market does. This really exists in our world of factor investing, which is, I've been saying this thing for years now, because anybody who invested, we invest in a multi-factor portfolio, but anybody who invested purely in value has had all kinds of pain. And basically the idea is if you want to get the value premium, that pain is necessary, but it's also a challenging thing to think through because sometimes you can suffer that pain and you don't get the premium. And so there's always some uncertainty around the premium, even though all of us who are value investors believe very strongly the premium will appear over the long term, there's always going to be some degree of uncertainty around that. So you're suffering this pain to get this premium. You're not 100% sure you're going to get the premium. I think value investing is one of the perfect examples of this.
Not only is value investing one of the perfect examples, this was the head scratch on this one was like how to take this one away from investing, because it's so, I think about it in the same terms. Like this is why value and momentum exist. You have to endure underperformance for the thing, for the religion of the philosophy you're going to pick to be at the core of your belief structure to see it out over time. On the kind of like the human capital side, on like the career arc, something that this made me think of is, and back to like risk transfer, like, and just comparing these things, there's other types of pain. So like on the human capital side, at some point growing up, like I should have realized I'm not smart enough to be the lawyer or the doctor. And I mean, not smart enough in the go to school about it solution. I think I'm a smart person. I'm not demeaning intelligence, but I am saying I don't think I'm smart enough to get through school and those things just because I'm going to get bored. Too much ADHD in me to get through that stuff. So it's a really interesting concept to think about. Maybe you can't be one of these traditionally higher earning careers. You're not going to go on to be that hedge fund manager or the president of the United States, all the things that when they tell you you're little, you could be anything when you go up. Thinking of, I can't remember which comedian is, it might've been a Louis C.K. thing where he's like, this is the reality of like trade schools where they're like, we tell you could be anything when you grow up. But then you get to somewhere in high school and they're like, there's basically 3 things you can do. This kind of feels like this. It's okay. In fact, it's a wonderful thing. There's a lot of careers you can make a lot of money doing. I have a lot of clients that work in like plumbing and HVAC and like construction or property, things like this that we think of as less than glorious job paths, but they're really, really great businesses. No pain, no premium might just mean so you couldn't go to school to get that PhD in tax law. But you know what you can do is you can fix people's air conditioners in the summer. You can fix people's, pool heating pumps in the summer. You can fix people's like boilers in the winter and all these things. And they're really good businesses. Now, you might not have the same status of say, look how fancy my job title or my thing is. But in many cases, you can have more money than some of the people who go off and do the other things. This no pain, no premium idea, I think shows up in a lot of life.
I was just actually thinking about it in my own career. This is cool that you're going this direction with this because a lot of Corey's lessons here will apply to life and not just to investing. I mean, we're taking it to investing and financial planning, but you can take it a level further to life. Like I was thinking about what I did, like coming out of college. So I worked at basically an internet startup out of college when I had like a very good job offer from GE at the time, which at the time was like the, a very premium company to work for. I mean, now things have changed a little bit with GE.
Move over Jack Welch. It's Jack Forehand.
He was in the picture at that point. So it was like a big deal to be like in GE's financial leadership program or whatever it was. Like that was a big deal back then. I mean, now I don't know about that, but anyway, like in making that choice, like there was significant pain along the way. Like that was the GE path was a much clearer path. Not that there wouldn't be any pain in it, but it was a much clearer path. But like by doing your own thing, by starting your own business, by getting involved in like a startup, which ended up with me starting my own business, like I've certainly endured significant pain. Like the first internet startup failed outright, and I've had all kinds of problems along the way, but I think I've probably gotten a premium in my career. Like I think I probably have a better career now with respect to money, but maybe more so with respect to like being able to do the things I want to do my whole life. Like before this whole work from home thing was a thing, like I've never not done it. I've done it forever. I think I've gotten a big premium in my life for doing that, but I've definitely suffered pain along the way. There's definitely been huge problems with the company. There was the failure at the beginning. So I think it applies there. I mean, maybe I'm carrying it too far, but I think it really is applied for me in my personal life.
No, because just like value investing is a core philosophy that if you stick to, you will endure long periods of pain, but at least historically, it's worked out for you over the longest of long hauls. Same thing if you don't want to pick value, I mean, just like owning that S&P 500 fund or whatever else has done very well, at least empirically for you. Doesn't mean it will in the future, but it certainly does in the past. So having that core philosophy that guides you so you can endure the pain and not just keep flipping to things that look in the moment to be less painful, I think that's a pervasive idea across life. And you choosing philosophically what guides you on your career to restack your priorities behind that idea with that alignment, like no pain, no premium is almost a better version of no pain, no gain.
So we're actually moving a little bit ahead with 6 minutes on the second one. So we're actually improving a little bit. But this next one is I think this next one is a huge lesson for everybody. This idea of diversifying cheap beta is worth just as much as equally diversifying expensive alpha. So everybody loves alpha. Like everybody is seeking that manager that's going to provide alpha or that strategy that's going to provide alpha. And like one of the things I learned a lot from Corey and from what the team at Resolve and what they've done with return stacking is they're basically taking a bunch of sources of beta. They're using leverage. They're building a diversified portfolio. And you could argue like they're basically getting a better portfolio without having to seek alpha. And they're doing things that are more tried and true, more proven over time. I mean, they're just betting on the asset classes. They're not trying to come up with some crazy edge or, find the next manager that's going to be the star manager. Like, I think that's such a great lesson because everybody wants to seek alpha. And sometimes you can go back to like the building blocks and you can do things with the building blocks that are going to get you more than trying to go find the alpha.
There's a lot of expensive beta out there. There's a lot of ways to say I'm going to pay exorbitant fees to own some crazy private equity thing, and I can build a really complicated, interesting portfolio out of really expensive things that just give me 60-40 numbers, or in some cases less. And this idea of you can return stack, you can do all these things with a little bit more thoughtful thinking of just saying like, just control expenses first. Like it's a messy world out there. Understand what the outcome is that you're after and understand how to balance these things. I to invoke the poet philosopher Billy Joel, I'd rather laugh with the sinners than cry with the saints. Like if your path is to go be a saint and do that thing, and like, okay, like go do it. There's nothing wrong. Just understand like the outcome that you're reaching towards is that might be a really expensive beta in your life that you're pursuing. Likewise, like laugh with the sinners, like have a good time, hang out with your friends and whatever. Know what you're prioritizing, I guess, is the real takeaway for me here. And sometimes the things that are most costly in terms of signals, choices, whatever else in life may not be the things that take you towards the outcome you actually want to receive. There's a lot of ways to get these cheap outcomes the best. Do you see like any other like life philosophy behind this one to you personally?
This is interesting, but also I want to just take a step back and emphasize what you said, because you said the word, expensive beta, which is so important, because he's in here, he said expensive alpha, but expensive beta is so important too, because there are so many expensive betas out there. Like expensive alpha might be bad. Expensive beta is even worse. Because at least with expensive alpha,
there's
at least you're attempting with expensive alpha to do something different to try to get a better return. Like there's so many closet index. I mean, not only in the private asset classes, like you talked about, like high fee stuff that's just generating the return of the asset class, but even in the public asset classes, there's so many like just, portfolios that effectively track the market that are charging you like a high fee. So it's like a carry forward of this, like also make sure if you're not going to, as much as diversifying cheap beta is worth just as much as diversifying expensive alpha, like getting rid of expensive beta is like a no-brainer in this whole thing. Like, and a lot of people don't do that. And a lot of people still have, things that are effectively beta that they're paying a lot of money for.
It is like you want to cry with the saints. You cry with the saints all the way up to being the Pope. Like what's the trade-off? What's the bet? How are you structuring this thing to get what you want out of the outcome? I think there's a deep well of philosophical underpinnings behind this point, and yeah, including swapping up some of those words, which I don't know if I did subconsciously or consciously.
Well, you did. It was great that you did it though, because it's a really important point. Because that's like even a lower level problem above getting to this higher level problem that a lot of people have.
All right, keep us on track. What do we got for number 4?
Diversification has multiple forms. This is a great one for both of us, I think, because this is so true. And if you think about it, like a great way to think about it is start at the top. Like, what can I diversify? Like, obviously, you can diversify across asset classes. That's one thing you can do. And then when you get into like the world I live in, you can, if you're a factor investor, well, do I want to be just a value investor? Probably not. Even if I'm a big believer in value, I mean, if you look at the data, like putting momentum together with value, it's such a compelling case. Like, why would I not do that? But then you even get a level below that and you're like, well, if I'm a value investor, should I just use the PE ratio? I probably should not just use the PE ratio. Or if I'm like with momentum, should I just use one signal? Or if I'm a trend follower, should I just use the 200-day moving average? No, I shouldn't. So like, as you work your way down, like diversification is, it's important across everything. And thinking about it all the way down for me has been like really important in terms of, not taking bets that I don't want to take or that don't have any value to me.
This is another one that I think just shows up in so many different areas of life. So in the financial planning thing, it's understanding, career paths. It's understanding like your career versus your spouse's career. Like I work in finance. My spouse works in healthcare. Like there's a bunch of core things that are very similar about what we do and how we take care of people and the relationships we have with the people we serve. But then there's a million other things where it's like we're a complete cycle apart in different times when people need us and can compensate us for the types of work that we do. The multiple and weird forms of diversification are really worth stepping back to think about. Another version I had, I was talking to somebody and they were talking about how, so basically it's a person who has like their friend's vacation and then their family's vacation. And I was just thinking about just this concept alone, like going away on the friend's vacation trip where it's like a very specifically curated like group of friends to do this thing. He could have invited me on this same trip to go do this like kind of like weird stuff that these guys are all into, and I would have been a total dud. I would have been diversifying, but actually would have ruined the experience for them because they would have wanted to do these like really specific things, and I'd be like, I'm completely useless in this example. Or likewise, it's like it might sound like a good idea for you and 6 of your friends to go on vacation all together, your friends' families or whatever, but you might find out stuff about their lives that you're like, maybe I wish I didn't know this. I'm not saying I learned this from experience, but you can imagine this idea that there's multiple forms of diversification and things that can mess that up or like work their way in. We just see it over and over in life. Anytime we are combining things together, we have to not just think about their relationships to one another, but their correlations to one each other, to borrow this portfolio term. We have to think about like, what's actually spreading out risk, what's actually combining risk, and then what's actually combinatorially dangerous in the sense that when we put this thing together, all of a sudden you find out like, oh, that guy's a closet alcoholic, or oh no, I'm on a fantasy football retreat and like I don't even know who like 3 quarterbacks are off the top of my head.
I was just thinking when you were talking about the guy you don't want on the trip, I was just for people, Matt and I just met for the first time face to face this weekend, and I'm like, I hope I wasn't the guy that. I'm
not referring to our conference experience.
At the Epsilon Connect conference was the first time we've done a podcast forever, but we never had actually met face to face till this weekend.
Well, you know what? But that's also a funny example. Like you and I having become friends over the last literally like 2 years, which just feels weird because I feel like I've known you for like 20 years and yet I've known you for 2 years. But understanding what's complementary. Like one of the great things is, and I've talked about this a bunch of times before, like this Howard Marks principle of shared values with complementary skills. A lot of times that's what you're looking for when you're building portfolios. That's what you're looking for when you build relationships. You don't usually want someone who's a carbon copy of yourself. You want variation that brings something like interesting to the table too. So enough shared values that directionally we're always pointing in the same direction, but enough complementary skills where different things can happen in different ways. Us getting together and going to this conference this past weekend is like the most brilliant version of like multiple forms of diversification combining for like a truly better outcome. Because I mean, we've got a lot of content we're going to be releasing in the next couple of weeks from just a couple of days together. And it's good and it's fun and it's brought like a genuine smile to my face for getting to mess with this idea of just multiple forms of diversification stacked up on top of each other.
Yeah, and it's been really cool for me too, like because you and I think about, I mean, like you said, we kind of at the base have a lot of similarities, but we also think about the world in different ways. Like I almost never understand your pop culture references you're bringing up. You're like some random band or whatever. I'm like, I don't even know what that is. It's actually kind of fun for me to learn as I'm going. And the only other thing I'll make on this before we stop is like, I do think what you said earlier is really important, which is a lot of people think about diversification in portfolios and they don't think about it in life. And you use the example of, your wife is a nurse, you're in the investment industry, but like there are a lot of times you can think about like in your life, like what are the risks I'm exposed to? And maybe how can I think about those risks? And sometimes those are not portfolio questions. Like sometimes those are just other questions. And sometimes they don't even relate to money. They could just relate to anything, like any sort of outcome in your life. And so I've always found like, and this is the quant nerd in me, but I always find like thinking about this idea everywhere can be really valuable.
Especially diversification. And I'm going to take us into the next one just because I think it relates. And that's about the philosophical limits of diversification. So this connection between diversification in the portfolio, which I'm going to let you talk about, but also diversification in life and in the choices that we make, like more money, for example, it can help alleviate stress, but it's not necessarily going to make you happy. This is a good example of something where like there's a limitation towards how much of something is a good thing. So what you were saying before about understanding how to apply diversification to life, you also have to know where the limits of these man, I can't talk today. These philosophies are. This is what happens. I had like way too many flight delays coming back from like our trip. I'm apparently worse off with like being sleep deprived for a night than I am with like having drinks for a few days. This is yeah, about to turn 43 apparently. So understanding the limit, and I always relate this back to, so Corey's talking about the philosophical limits of diversification, which you're going to talk about on the portfolio sense. I always go back to, this is Spinal Tap. I always go back to, you know, do you know this reference? Do you know the turn it up to 11 reference? Does that mean anything in your world?
Probably not at the level you know it.
All right, we're going to get together. We're going to watch Spinal Tap. That's going to be our next thing. And you're going to love this because it's a music mockumentary about like a metal band and basically in the declining years of their career, for lack of a better word. And so there's this iconic scene where the guitar player is showing the guitar amps, and all the guitar amps traditionally have a knob that's like, it starts at 1 and it turns up to 10. Just like the speedometer on your car, like it has a limit to this thing. And he's, you know, going into detail about how all of his stuff is different because his amps go up to 11. And it's for that thing where you're already on 10, but you need to just take it a little bit more. And most amps, you can't do that, but his go to 11. Now we all know like there's a banded logic of what an amp is capable of doing for amplification and whatever else. But this psychological idea that like, oh no, these go up to 11, and he actually shows the knobs and they go up to 11. It's a complete brilliant piece of both comedy and psychology. But it's this idea that even things like diversification have natural limits, and we can lie to ourselves and make jokes about where those limits are and how we perceive them. But the reality is, you gotta, to me, the best way I always learn stuff, and previously in my music life that I carry forward to life today, is take the knob, turn it all the way up and turn it all the way down so you can kind of understand the range by which something works. So I invoked now Spinal Tap and way too many other things. How can you explain the philosophical limits of diversification on portfolio terms?
Well, I don't know how I top that. Now I got to go to like the boring world of investing after you just come up with a Spinal Tap reference, but I'll do my best. But the idea is that you start with, like, just think about it, investing in general. Like I start with T-bills, right? I'm invested in T-bills, and now I want to start adding some risks into my portfolio. But then I say, you know what? I want to diversify away those risks. Like where do I end up? I end up right back at the T-bills. And it's the same thing also like in investing. Like if I start with the S&P 500 and I start building a factor portfolio, and I'm like, all right, you know, if I do an equal weighted factor portfolio, well, I'm going to add some value to this, and I'm going to add some momentum. And then just by its nature of an equal weighted portfolio, I'm adding some size to this. But like, I don't want to take that size risk. So why don't I go back and market cap weight my portfolio? And I don't want to take that value risk. That's too hard to endure. And I don't want to take that momentum risk. Like where I end up is right back at the S&P 500. So the idea is like, you have to, if you want to get some sort of extra return, you have to take some sort of risk. And like, sometimes you can get so crazy with like, I'm going to diversify this away, and I'm going to diversify this away, and I'm going to diversify this away, that I end up not taking that risk. And I end up right back where I started. So it's not just, I mean, it's an investing thing. It's a life thing. It really works everywhere.
In that point, it goes back kind of to the expensive alpha or over expensive beta too, right? Like you've seen multi-factor portfolios where the whole thing stacks up and you have an expected tracking error of like 1%. And you're like, what? You have this wonderfully complicated portfolio, but basically this thing is only expected to do what the market cap weighted like. You can make it really complicated without having anything that's additive to the mix.
That's right. All right, we're up to number 6. 28 minutes, Matt. We're not going to make it anywhere near the end.
We are flying.
We're really starting to crank it up here. This one I've got a good example of. So it's usually the unintended bets that blow you up. And so like, I'll give you a good example of this from factor investing. So let's say I want to run a value portfolio. And let's say I want to buy the cheapest stocks. And I run my screen, I buy the cheapest stocks, and it's 2007. And you know what? Like there's just tons of cheap stocks in financials. So I just buy a boatload of financials for my portfolio. So my intention there was to build a value portfolio. But what was this is obviously a very basic example. It gets much more deep with what Corey does, but like, what was my unintended bet there? My unintended bet was on financial stocks. I didn't intend to bet on financial stocks, but I made a massive bet in financial stocks. And obviously I got completely destroyed in 2008 with that unintended bet on financial stocks. So the idea is you have certain bets you intend to make, but there's always all these other bets beneath the surface that you actually are making as well, along with that intended bet. And to the extent you can manage those bets, they're less likely to blow you up. So you probably have a better example for life, but that was just like a very egregious example I thought of like from the world of factor investing.
Well, I'm going to give you the related life career lesson that directly correlates to that you just made me think of. On the career progression side, it's the same thing. I was determined. I started my finance career coming out of music, wanting to make sure life was adequately boring. And my first finance job was I was a part-time teller, which is very glorious. Lasted very, 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 very short career as a part-time teller. But I had all these voices around me that wanted me to go like this banking and like run banking centers or be like in leadership somewhere on that side. That was like the way that people were guiding me. And I knew that that wasn't what I intended to do. That didn't seem fun. That didn't seem like I looked at people, it was like, I don't want your life. Who else do I know that I feel like I could be doing what they're doing? And so I looked at some people that I had gotten to know in more like commercial banking or business banking type services. I looked at some people that I had gotten to know in like mortgage and residential lending and things like this. This is pre-financial crisis. This is why this matters. And I looked at somebody who was like a financial advisor and doing what they were doing. And I was like, well, which one of these makes sense? And I decided I didn't want to do the commercial lending thing. And there was a whole bunch of reasons for that, because I thought, well, that's the underwriting and structuring of these deals, or even trying to go in the investment banking route that I knew I didn't have a chance on. I was like, I'm going to run into a wall really fast on that. And on the mortgage and that side, like the consumer side of things, I was like, well, that's interesting. And at the time in like 2006, 7, I was like, well, those people are making a ton of money. They don't seem like they hate their lives. They're getting to talk to regular people and solve these problems of like, how do I afford a home or whatever else? I was like, okay, that's actually pretty interesting. I should interview for some of those jobs. And then likewise on the financial services side, I was like, I'm really drawn to helping individuals with a broader picture than just the mortgage. So at first, I got a really quick couple of like offers or people trying to pull me forward on the go into like mortgage, like origination sales, whatever you want to call it, into that route in 2000, let's call it 2006 or 7. And I had gotten to know a person doing that job, this woman, Sandy. And Sandy basically said to me, like, you don't want to do this. Like, go the financial advisor route, go that route. You'll be very good at that. But right now, she had been through multiple cycles at this point. She was like, this is not the time to do this thing. And you know what? She was friggin' right. She was dead right. She knew something else was going on that I could have intended to go make some good money, feel good about the work I was doing at the time in this space, my early mid-20s or whatever here. But that was an unintended consequence that probably could have been a career ender for me in that space at that point in time. Now, I had the disastrous decision. You were, getting long financials. I was getting long a financial industry career right after the whole thing went off the cliff. But the brilliant unintended upside of that experience was I got into an industry when a top was basically happening. And I had just enough that I could hang on, and I survived the crisis. And I learned so many things because I started with a crisis in the windshield, not in the rearview mirror, that was a profound shaper where I was able to hang tight and survive in the business through that downturn. I wouldn't have been able to do it on the other paths, or at least on the mortgage path. The banking paths, it's really, really interesting because financial services as a job, and I felt all the pain you did and endured it on a different way on the human capital side instead of on the investment capital side.
Yeah, actually, I picked up two things from what you were saying. One is, it is important to think about unintended bets in the other direction too. Like, it is the unintended bets that blow you up, but sometimes the unintended bets, like you don't anticipate betting on this thing, or you didn't try to, but it actually creates some like really positive outcome for you. Like a bet you didn't think you're making, you were making it, and it makes, it creates a huge positive for you.
I'm 15 plus years or whatever into this career now on like this side of the table. And I can wholly say completely unintended. It was based on, 25, 26-year-old me looking around a room and being like, don't want that person's career, don't want that person's career. They don't look like they hate themselves. Maybe that looks good. Huh, that guy's got a nicer car than that manager over there. Like, I guess, like, is this how people make these choices? Up to this point, I was just basing my entire life on how many people would show up to see a band I was in play or whatever else. And trying to figure out how do regular people make these decisions? Like, if other people value this stuff, maybe I should too. Completely unintended. And without that, you and I are not friends and not having this conversation. Never in a million years would I have picked that path.
And I think the other thing I want to say is, like, I think it's useful to sometimes try to write down the bets I am taking, because it makes you think about the unintended bets. So, like, both in investing and in life, it's like, I want to bet on this thing, but here are the other things I'm betting on. Like in my career, I'm obviously betting on the economy to some degree. I'm certainly betting on what the stock market is going to do. Like there's all these things you can look at and be like, and sometimes you find a risk you didn't know you had. And on the investing side, at least, and maybe on the career side too, one of the cool things about finding a risk you didn't know you had is you might be able to do something about that risk. You might be able to mitigate that risk in some way because you're like, I don't want to really bet on this thing, but I'm betting on this thing. Maybe there's something I can do to mitigate that. So I think it's, to me, and this might be the nerdy side of me, sometimes I do just say, like, here with what I'm doing right here are all the bets I'm taking. Here are the ones I want to take. Here are the ones I don't want to take. Is there anything I can do about these ones I don't want to take?
Use this to take us into the next point. So 7, basically it's long short portfolios all the way down. Because I think part of the exercise of writing down the bets you're taking and then choosing the bets you're not taking is understanding, say it in portfolio terms first, like what you're long and what you're short, because doing one thing is not doing another. And that's part of that exercise.
Yeah, the idea is, I mean, you're always betting on something and you're always betting against something else. And I think Corey used the example in the paper about, like, with a factor portfolio, you've basically got a long short bet with like another bet stacked on top of it. Like the idea is when you think about, but at a high level, I think the idea of thinking about like what's your long and what's your short is important. And it can help you kind of analyze what I'm actually doing relative to what I'm trying to do. It's a way to break that down into individual components and to say, like, what is it that I want to be doing here? What am I betting on? What am I betting against? Do I want to be betting on that? Do I want to be betting against this? So you may have a better, like, real world example to think about, but that's kind of the way I think about it.
So I'm going to keep it with the career idea for a second. And it's being like long one career might be being short another career. There's certain things you can't do at the same time. There's certain realities. Like I couldn't really be like a bank teller and a musician. And that was on purpose. I mean, you could, but it was one of those, like, it was hard when you had to work every other Saturday morning in a banking center to, be out till 4 a.m. or something the night before. You could also be like, you could be long people. I can be long relationships, but that doesn't mean I'm short loneliness. That doesn't mean I'm short good relationships. You can surround yourself with a group of people and say, I have these people around me. It doesn't mean you're surrounded by good people. There's combinations of these things. When you understand long and short, just like when we use a long short portfolio to explain the value premium existing, what we're actually doing is saying these two things that we're controlling for on each side of a concept get us to, like, what's the core idea in the middle? What's the emergent premium? What's the emergent, like, factor? Why we think this exists in both directions, both by being long it, by owning this concept, but also being short this other thing. And again, back to like the relationships example, I can be like long good relationships and short loneliness if I have people around me that really care about me and whatever else. I can screw that up by have a bunch of people around me who don't care about me or don't care what I am. I can still be surrounded. I can still go to a job and work with a bunch of people who are just, sociopaths. And one of the crazy things, talking to a bunch of high finance people in particular over the weekend, there's a lot of people who did a lot of years on Wall Street and places and were just like, oh, I was surrounded by sociopaths every day. Like the only thing I had was going home to my spouse in the evening or whatever else and my kids. And it's like, holy crap, does that shape your worldview in a warped and messed up way? But understanding that, and many of those people at this Epsilon Connect conference were there in service of healing these human relationships and having more human relationships with other people, which is, again, really interesting the way to say, like, I'm long relationships and I'm short loneliness, but unless I understand those things together, then I might not actually get the outcome I'm aiming for unless I'm thinking that way. That is some next level intentionality in this concept.
And just a quick plug before I introduce the next one is, like, I would highly recommend that Epsilon Connect conference, for anybody. I've been to so many, like I went to a financial planning conference recently, and with the financial planning conference is basically like a bunch of people who paid to be on stage, being on stage where they make some sort of point about inflation being here forever and then try to sell you some sort of product. And then you get to head over to a bunch of booths where people are like trying to sell me things at the booth. And like, this was the exact opposite of that. I mean, no one tried to sell anybody anything. It's people from all walks of life, like who certainly all had an interest in investing, but like, it was, everything from teachers to, yeah, I mean, anything you could think about, like in the world, like the types of jobs, they were all there, and it was just a great group of people who wanted to learn from each other. So anyway, that's an aside to recommend that for anybody who wants to do that in the future. But we're back. I'm going to move to number 9 now because I think this is a great one. And that is certain signals are only valuable at extremes. And this is really good for me in investing because this is something I've learned over my career. So I was one of those people like back in 2014, 2015, who was like, value is cheap. So the value spread, the spread between growth and value, is a signal. I can say whether value is cheap or it's expensive relative to history. And what I also can do is say, all right, we've reached the 30th percentile here, so value is getting really cheap. And what I also can do, which I did, is in the next year, I could be like, all right, we're at the 20th percentile. Things are getting really great here. And then the next year, I could be like, all right, we're at the 10th percentile. We're really getting good. But the value spread is one of those things, and I think Corey might have used the same example in your interview with him, but it's one of those things that it's really good at the first percentile. And even at that, it's not great as a timing signal, like things are about to turn tomorrow, but like the value spread being in the 30th percentile really tells you basically nothing. So that's a really good example of something that's it's a signal, but it's only a signal that probably has any value at extremes. And even because of the behavioral reasons, like it might not, for a lot of people, it might not even have any value at extremes because of the behavioral part about like, even at the first percentile, we still had a lot of value pain after that. So I don't know if you have a life example, but that's the one that came to mind for me in the investing side.
The one that I hadn't thought of until you were just explaining that right now is this makes me think of there are no atheists in foxholes quote. And maybe we're coming off the D-Day thing and the stuff is fresh in my brain or something. I don't know where this connection came from, but it's this idea that there's actually a lot that can be learned from studying the things that work in extremes, but don't necessarily serve us when we're not in extremes. And there's a lot of adaptive and maladaptive behaviors that we learn in extremes psychologically that are bad when we carry them into the rest of life. This is really interesting. I may or may not get to this in a upcoming Intentional Investor with Daniel Crosby, but he's written a lot about this, and that's probably also where I'm making this connection right now. So this idea that certain signals will only be valuable at extremes, and that means you kind of need to hold them in your pocket for those extremes. Like say the prayer in the foxhole, invoke God if you want to, if you must, or whatever else. But then decide when you come back home from the war, what's adaptive or maladaptive about that thing. It doesn't mean you need to go put one of those like 2-paneled cutouts and say the end is nigh and parade around the street and try to evangelize some religion like you're still in a foxhole. But it might mean you need to go work at the soup kitchen and take care of vets in your neighborhood or something else. Those are two types of signals that you can send out in the world, but like their value and their purpose that they serve you psychologically is a big deal. Same thing with work and meaning and retirement. There's certain things like saving for retirement, getting in the habit of setting stuff aside, getting the frugality mindset like together in saving mode is different than having the frugality mindset together in spending mode. These have to do with these identity shifts that happen over time and understanding when something is serving you and the broader mission you're trying to achieve, and when something is working against you because it's only useful in a very narrow set of circumstances. Philosophically, there are through lines, but there's some really profound stuff behind this concept.
The one thing I was thinking about with that is this idea of like the value spread only being useful at extremes. Like your example of it, something that if you time that properly, let's say you only got introduced to it when it was at an extreme and you used it, like not carrying that forward is so important. Because if it worked for you at an extreme, you might think it works for you in all circumstances. So next time, you bought the first percentile of the value spread, it worked out for you. You might be buying the 30th percentile next time and not realizing, that it was a signal that it only works at extremes. So it's important to think about it on both sides, I think.
I think it's very important to think about it on both sides, and it's very important to think about how does this thing serve you both in the extreme scenarios and then also in your base case, or just plain English, in your in your normal scenarios, does this thing still work? On the battlefield, when the bomb goes off or the big bang happens, it works to hit the deck. When I'm walking my dog on the street and somebody slams a car door behind me, it's probably not a good time to like scream and hit the deck. Easier said than done, and especially if you were, exposed to deep types of trauma like being in a war zone, but that logic actually carries through to a whole lot of life.
So Matt, we're running out of time here. I don't think we'll get through all of them, which I guess is what we kind of guessed at the beginning. But there are two more I wanted to make sure we got through because.
Are you saying that our prediction was fallible? Is that what you're suggesting?
I think so, and I think there's probably some lessons if I go back through all 16 here that we could have learned that from the beginning. But as you know, you and I, it takes us a little time. As people listen to us know, it takes us a little time to learn these things.
That's true. That's very true.
At least we do it live on camera, though. That's a great way to learn it.
Well, but you're gonna read the thing. But let me just say, this next one, we're talking about Halvsies, which nothing brings me greater joy than somebody like Corey Hoffstein using a word like Halvsies, because I feel like he's mortal after all. And there's great joy just in the language and word choice on this one for me.
We both know he has an 8-syllable word he could have used if he chose to illustrate the same lesson. And he chose not to go with the 8-syllable word, which all of us appreciate who probably would not have understood the 8-syllable word.
Yeah. There's some weird like heteroskedasticity or something like that that's applicable
There's a
here.
direction he could have gone had he chosen to, and he chose not to do it. So I greatly appreciate that. But anyway, this is a really good one too. This idea of halvesies, because it gets at a lot of the other stuff we're talking about, like diversifying signals and things like that. But like, I think a good example of this halvesies thing is, so let's say we existed in a world where I can only use the price to book, which obviously is not the world I want to live in as a value investor because I don't love the price to book. But let's say I can. And let's say I've got this problem of a lot of these companies have significant intangible assets right now. Those intangible assets are getting expensed. They're not getting capitalized. It makes like the price to book of some of these companies, some of them wrong and some of them like outright worthless. So now in the future, I can only use the price to book. I got two choices. I can use the price to book, or I can use the price to intangible book where I adjust for this. What do? Like, on one hand, the price to intangible book makes a lot of sense. But on the other hand, like a lot of these intangible companies have been doing really well. And also, like when I get to the bottom of the barrel on the price to book stuff, like those really are companies that have that many intangibles anyway. Like, how do I pick? And I think one of the ways to handle that problem is what Corey called halvesies. I could basically put half my portfolio in these really cheap, low price to book stocks, and I could put the other half in stocks that are cheap on price to intangible book. So that way I'm splitting the difference. I'm going halvesies. And like he said, there's strong uncertainty. Although I don't love the price to book, there is strong uncertainty in the next, if I was to say in the next 10 years, which one of these signals is going to work better, there's strong uncertainty as to which one that's going to be. Although the intangible one might make a little more sense. So under strong uncertainty, split the difference. And I think that's a great example. Or you may have a different example, but I think that's a great way to look at it.
I like your example. I think that it is it's more of a real world example than anything else. And one of the places I would say this shows up in the real world is just in there's different types of choices that we make. And we think about what type of choice architectures we want to put around the choices we make to help guide these things. And under conditions of uncertainty, which I'm going to broaden out to say, under conditions of like, I know where I'm directionally oriented, but I don't know exactly how this is going to play out. So as an example, the other day I made the life choice of there was a donut that I really wanted to eat. And there's also like a salad for a meal later. And these were separated in my day.
You're not going to tell me you put the donut on the salad, are you?
No. But in the morning, it was like, this donut, I really want to eat this donut. But I am going to consciously choose to eat healthier later in the day after consuming this donut. Now, the reality is like one donut is not going to destroy my physical health or whatever else. I don't want to have a donut every single day, and justifying, even though it's not hyper rational in my brain, I'm going to have the donut and eat the salad later. Like that's a better practice than being like all donuts or being like, oh God, I wish I ate that donut again, like later, because all I'm doing is eating salads. There's a lot of parts of life where if you just get the directional orientation correct, and then you take other things that you don't know and you split them, you can either split them because life's more rewarding when you eat a donut, that's personal philosophy, or you can split them in the sense of like, I don't know which of these two things to pick. I don't know which one of these is the better choice, like price to book versus price to tangible book, and what's going to play out. When you don't know and you're in that case, sometimes you just need a simple rule to guide you and pull you all the way through. Halvsies is a brilliant way to say, is there a reasonable way that I can take on two things that won't kill me? Is it reasonably okay that just this once on Saturday, I eat the donut and I make sure I eat healthy for dinner tonight? This is a very simple, and I know I'm bastardizing the concept and taking it away from the initial source material and how you do it. But there's just so many parts of life where if you just recognize the split and that you don't know which one is the ultimate right answer, but they're directionally oriented in the correct direction. Too many uses of the word direction in that one. But if you're pointed in the right direction and you understand why you can split this and just let the future play out, it's really handy. And it keeps you from having to do the coin flip game. The best thing about Halvsies is I'm not flipping a coin and picking a direction and then being like, oh my God, I picked tangible book instead of regular book and I screwed myself up, or vice versa.
I'm happy you've approved the barbell portfolio with donuts and salad because I'm going to go with that way going forward. So I'm happy I've got the Matt Ziegler endorsement of this new portfolio.
The real problem is that I have donuts on my mind again because after staying off the donuts for several days, including rejecting, I didn't know Voodoo Donuts had like expanded the brand. There's a Voodoo Donuts, which normally you'd have to go to the West Coast and you have to go to like Portland for. There's one in the friggin' Nashville airport. I walked past that thing and I was like, this is like putting like a crack dealer like in your kid's cafeteria or something.
You didn't have it.
This should be allowed. I avoided that, but this morning you got a surprise gift from my favorite donuts from as a kid. These Redner's donuts, which almost don't even qualify as donuts, but it's like a pure nostalgia play. Yeah, I got my dog from my parents. Watched our dog for us while we were gone, and we got the dog, but we also got donuts back. And I'm just like, it's just dangerous in the house. I don't know how many salads I'm going to be eating for the next few days, but I've got 5 Redner's donuts standing between me and some really poor non-Halvsies choices.
So one more, and I know we got to wrap up really quick here, but I wanted to get this last one in because what he had is a back test. It's just a single draw of a stochastic process, and that really relates to the quote from Adam Butler I use a lot, which is the past is just one sample draw and an infinite series of sample draws. And the idea is like, yes, the past played out one way, and you can back test things on that one way, but it could have played out really, really differently. I mean, especially when you think about things like inflation. I mean, there could have been a lot more inflationary periods in the past 40 years than there actually were. And if you just run your test on those 40 years, you're not going to get the reality of what you can learn from those 40 years because it could have played out differently. All kinds of different things happened along the way that could have gone in different directions. Government policy could have been different. You know, different people could have won the presidency, whatever it is, like all kinds, the Fed could have behaved completely differently than they did. There's so many things that could have been different. And when you back test, or when you look at the past in any way, even if you're not a quant like me, you're just looking at the past and saying, what lessons can I learn from it? You've got to understand it could have played out very, very differently. And to Corey's point, what we saw is only a single draw. There could have been a lot of different draws besides that.
The simple version is past performance is not indicative of future results. The more nuanced version is everything you just said. My favorite quote on this that I need to look up to attribute, but I'm sure somebody can look it up and figure this out. Like, it basically is more things can happen than will happen. So there's a lot of things that could happen, but only one path is the path that we follow. We have to remember that anytime we're looking back, that one thing happened, but more things could have happened. Just remembering that a backtest is a single draw in a stochastic process is remembering that perspective and the things that we plan going forward, but also how we contextualize the things in that rearview mirror.
Yeah, and I think that's a great thing to wrap up on. For anybody who wants to get a more intelligent take on this, thinknewfound.com, Corey's blog. Matt and Justin did an interview with Corey, which we paired with Ben Hunt on our channel. So if you search Ben Hunt, Corey Hoffstein, excess returns, you'll get that one where Corey explains this better than we can. Thank you, everybody, for joining us. We'll see you next time.
See you, Jack.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.